Hi guys, welcome back to the channel. My name is Dave, and today I want to share with you the 4 ETFs that I like to buy and add to every single year with no regrets. So, if that is what you're looking for, please stick around. Whoop! Question: what do Chaz Munger, Mo P, and I all have in common, besides singing a mean rendition of Brass Monkey? Well, let me tell you, we all bought Alibaba stock. That means we had a big loss in an individual stock. That's right, we made a bad choice. So even the best investors in the world, and me, can sometimes make a bad choice when it comes to an individual stock. So how can we avoid such problems? Well, we can just buy simple ETFs. So what I really love about these ETFs is that you can buy and hold these forever and reduce the volatility of owning an individual stock. And that's what these instruments are all about. If one stock sinks, you don't sink the whole boat. And whether you're brand new to the market or a veteran, ETFs are a great way to continue to grow your portfolio. So what I would hate to see, because I get this question a lot, is a person comes in with their first $100 or $1,000 and they want to start investing. They ask me about options and they ask me about individual stocks. And sooner or later it comes around to, should I buy Tesla? And I'd hate for your experience to be, put all your money into Tesla, Elon comes out, tweets something silly, it gets cut in half, and you're like, oh my gosh, I'm never getting in the stock market again. Whereas if you bought an ETF that owns some Tesla, you'd see a small little blip, a little correction. You'd be able to dollar cost average and buy some more. You probably wouldn't feel too bad. You'd be able to start growing your wealth with time. So ETFs are much better when you're first getting in the market. So real quick, what is an ETF? It's an exchange traded fund. It's a basket of securities that tracks an index. Simple enough, right? It can have stocks, it can have bonds within it. But it's not a mutual fund. Don't confuse the two. Mutual funds are professionally managed. They tend to have higher fees. I'm not a big fan because they tend to try to beat the market and fail at that job usually. So the only time I go to mutual funds is when I'm forced to within a 401k or something like that, for example. Another version of this is an index fund. The only limitation on an index fund is you have to trade. You can't trade intraday. So an ETF you can trade, you can buy today and sell today, and it's real simple. So I like to stick with the ETFs. Now, having said that, I never go and buy and sell within the same date on an ETF. I buy and hold these long term. And finally, before we jump into these 4, I want to talk about one of the biggest factors, and that is fees. So when we're comparing very comparable products, one owns 7.3% of Microsoft, and this one has 7.4% of Microsoft, really comes down to fees for me. So you can have fees that are 10 times what they are in this one to this one. So we want to always look at that and focus on that. These fees come out in the form of not when you buy it or sell it, but on a daily basis. So you really won't feel them, but we want to know about them, especially when we're talking about such a similar product. Enough fluff, let's jump into these top 4 now. And coming in at number 1, the one I've owned probably for the longest, is the Vanguard 500 Index Fund. This is ticker symbol VOO. And you can see right off the bat, pull information up here. VOO has not had a bad year in the last 10 years, and none of these 4 have. It's been an exceptional 10 years for these ETFs. And you'll see the price performance and everything listed down here below. But let's start with that net expense ratio that we started to talk about. So at 0.03% annually, if you had $10,000 in there, you would be paying out $3 in fees that you wouldn't see. Like I said, they'd be getting pulled out, and that would be reflected in your return. So this price performance of 26.7% over the last 52 weeks is phenomenal. And right next to that, you have one SPY that's 26.56%. So right off the top, I want to kill this SPY off because SPY here has a net expense ratio 3 times that of VOO. So there's no reason to buy SPY over VOO when they're going to take 3 times your money. Like I said, it's only $3 when you have 10,000, but as it goes up, it's going to become more and more significant. So when you have $1 million, we're talking about $300 versus $945, and that's 6 sushi dinners. So let's go with VOO as our top choice. And you can see the price performance is actually slightly better. Now, they're going to own very similar products, and if we break that down and look at it, we'll see that. So that is to be noted right now. I'd say buy VOO over SPY. The next thing to note on this chart is the return. So you can see 1 year, 5 year, 10 year. Wow, incredible. Over the last 10 years, returning over 16%. That's phenomenal. If you can get that, you know when your retirement's going to come because that is phenomenal. Now, it also does pay out a distribution yield of 1.25%. So not too shabby. So for those that like to get a little bit off the top and reinvest that into something else, this one pays 1.25%. So now let's take a look at the holdings. Now, the top 10 holdings for this one, and you're going to see this similar across all 4 of these. Well, actually, there's going to be some differences, but when you're coming to VOO and you're looking at SPY and the other ones, you're going to see very similar products. So in this case, you got Microsoft at 6.35%. You got Apple up there, Amazon, Tesla, Alphabet, right? Meta, what's that? Facebook? Okay, can't trick me. Nvidia, Berkshire Hathaway, great stocks, and that accounts for nearly 30%. And you can go in, but you can see this owns 514. So with the purchase of one share at $427, or you do this on M1 Finance and you buy a partial share, you're going to get 514 different stocks in your portfolio with this one ETF. VOO also has over $268 billion in net assets at this point. So an incredible ETF, one that you can buy, and obviously in past performance, which we can't say is going to guarantee future returns, but phenomenal past performance to base this upon. So VOO is my number one. It could be number 2 or 3 or 4. All 4 of these are phenomenal. Buy and hold forever. But VOO, number 1. All right, number 2 for me is VTI, Vanguard Total Market ETF. And this bad boy has 4,127 different holdings. After all, it is the Vanguard Total Market ETF. So when you're buying this and you spend $238.21 right now on one share, you're getting 4,127 different holdings. Pretty phenomenal, right? So if you look at the 10-year chart like we did on the other one, you're going to still see a phenomenal return over the last 10 years. And that 10-year return would be about 16.1%. Amazing. That's just great. There's no point along there where you could have failed. You could just keep buying, dollar cost averaging. Again, very similar to VOO. Net expense ratio of 0.03%. Distribution yield right about 1.2, 1.25%. So again, it's going to put a little bit in your pocket every month. And when we flash over here and we start looking at holdings, we're going to see Microsoft, Apple, Amazon at a little bit of a reduced rate from the VOO. But you know what? That's because you're getting 4,127 different holdings. So some of that percentage is going into all these other items. But again, everything from technology to consumer to energy to utilities to real estate, it's all over the place. So you're buying a little bit of everything with your $238.21. And that's one of the reasons that I feel that you can buy this dollar cost average year after year and be quite successful with number 2, VTI, the Vanguard Total Stock Market ETF. One little caveat for all those option traders out there that follow along here. While I bag on SPY, it is the most liquid ETF when it comes to options trading. So if you want to go out and you want to trade options, that's when I would say check out SPY with expirations on every Monday, Wednesday, and Friday. And a lot of people do that and they just trade SPY. So if you're looking for options trading, that's when you want to look at SPY. But otherwise, I'm looking at VTI or VOO as a replacement product for SPY. All right, moving along. Number 3 for me is VUG, Vanguard Growth Index ETF. Now this one is going to be focused on growth. So if you're not concerned about having a nice distribution, if you're not worried about giving that dividend every so often, well, this is the one for you, because then you can focus on growth and you don't have to worry about paying those pesky taxes. This is going to be more focused on those tech sectors, right? So the biggest holdings are going to be like Microsoft, Apple, Amazon. Sound familiar? But again, with a reduced distribution yield, you're going to be able to focus on growth. If we look at our 10-year chart here, we're going to see that outstanding growth. This year, over a 30% return over the last 52 weeks. Amazing. Net expense ratio, 0.04%. So still very, very low. Just slightly higher than VOO and VTI. But an outstanding return. And over the last 10 years, nearly 19% return. Ouch, that's amazing over a 10-year period. It really is. It's been a great time. So get yourself some VUG, and you'll sound like a Scandinavian guy or something like that. But anyway, so outstanding performance. And when you're looking at their holdings, pull those up here now. We're going to see there's 278 holdings, and it's going to be Visa, Home Depot, Meta, Alphabet, Tesla, Amazon, but obviously at a higher percent because it's focused on those growth stocks. Okay, so you're giving up some dividend yield, but we're going to focus on growth. So an outstanding one that I've been buying, again, buying for years, reaping the rewards of having all this growth. So get in there, get yourself some VUG. And again, there's a QQQs would be a comparable ETF to this. But if you look at QQQ, I believe the expense ratio on that is 0.2%. So think about that. That's 5 times higher than what we're looking at here with VUG. So I would stay away from QQQs unless, again, you're really into options and you want to trade options on QQQ, which is still a pretty liquid option for options. So that's when I would steer towards QQQ. But otherwise, put it aside, focus on VUG. And number 4, VYM, Vanguard High Dividend Yield ETF. So what we're trying to do with this one is we're going to try to get some money off the table in the form of a distribution dividend every quarter. So in this case, about 2.8%, quite nice. So if you're getting a little bit older, you want a little bit more off the table, then this is the one for you. VYM, yielding 2.8%. And it's going to give you a completely different asset class than VUG, where that one's focused on growth. This is going to be looking at all those value stocks that pay out those nice dividends. So in this case, a little bit higher net expense ratio, 0.06, actually double of VTI and VOO, but still not too bad. $6 per $10,000 invested, and it's returned phenomenal 20% over the last 52 weeks. We look at the 10-year chart. Again, outstanding over the last 10 years, no bad time to buy. Over the last 10 years, 13%. So a nice return as well. Now they've got about almost 40 billion in assets and that nice dividend yield that I like. So I've been adding to this one because I do like those dividends. Think about it. If you have $1 million in this thing, you're going to have $28,000 annually. That means you're going to be, when you get to 10 million, let's just fantasize. We're going to get to 10 million. We have $280,000 to live off. That's like weekends down in Jamaica on the grill, hedonism, all that fun stuff, right? And if nothing else, a barcode of Mally's. Who knows? But we're going to be going, having some fun. Now let's look at the what they actually are buying. And you're going to see it's very different than VUG. So it's going to complement that growth fund by adding a lot of these other ones there, like JP Morgan, Johnson & Johnson, the Home Depot, right? Bank of America, Procter & Gamble, Pfizer, and so forth. So you buy into this one, you're getting 413 different holdings for your $108.48. And it's just a great way to diversify. So VUG with VYM, some of these other ones, are going to be all over the place. But you can really focus and decide you want a little bit of money off the table and you want to reinvest that. Again, I always talk about M1 Finance. It's one of my favorites. You buy some of this, and when you get those quarterly dividends, it gets into everything else. I love that. I'll link a video above talking about that and why I like that strategy so much. But just a great way to go about it. So those are my top 4. What do you think? So full transparency, I do own all 4 of these ETFs, and they're a core part of my portfolio. And I will continue to add to these positions. I have a belief in these products. Besides, they save me from myself and those guys getting in my head to say, buy Alibaba stock. I also own individual stocks as well, but I do like these. So if you have any questions about any of this, please ask down below. If you wouldn't mind, please like and subscribe to the channel. Future content will be coming out. I really appreciate you watching and spending some time with me. Thanks so much. Take care. Whoop.